how to reduce capital gains tax. And so the best way to explain this is to walk through an example. Let's say, for example, you bought a house and you bought that house for $400,000. Over time, that value of that house grew to $500,000, and at that point in time, you sold the property. Sold the property for $500,000, but you purchased it for $400,000. That means you've made a gain of $100,000. Now, this isn't exactly how it works. We're simplifying it significantly. If you've claimed a depreciation and those sorts of things, then you've got to take that off the cost base. So there's a few other calculations to work into that, but just for simplicity, we're assuming $100,000 profit. If that was held, if you held the property for longer than 12 months, then the $100,000 is reduced by half, because you get a 50% discount by holding it for 12 months. So your $100,000 becomes $50,000, and then if you held it jointly, then that $50,000 is split between the two of you. And we're going to use Joe and Mary again to show you two different ways in which you can save tax on these capital gains. Joe is a salary earner. He's employed, and he earns $70,000, and he also earns interest, and it could be the rent from the property of $10,000, or it might be just other assets that he's got earning $10,000 in interest. He adds to his taxable income $25,000, and ultimately ends up paying about $9,625,000 in tax on that capital gain. Now, Mary, his spouse, she's not working, but she's got investments that are earning $37,000 per annum, and the capital gain is again $25,000. Because she's on a lower tax threshold, the tax that she pays on the gain is $8,875,000. So the question is, how can we reduce the capital gains tax on the sale of this investment? Because it's a significant amount of capital gains. It's a tax. It's $18,500 in total. Now, if we look at Joe, it's a bit different for him because he needs to use salary sacrifice to reduce his tax. So what we're doing, we're effectively reducing his income by salary sacrificing, and therefore you're saving capital gains tax. The benefit here is reduced significantly, again because of the concessional contribution limits being reduced. But if he doesn't salary sacrifice, his taxable income is $80,000. He adds to that the gain of $25,000. His total taxable income is $105,000. He pays tax of $28,372. Now, what he could do, and it's important here with this salary sacrifice arrangement, is that if you're thinking about selling an asset, you need to set up this salary sacrifice arrangement early on in the financial year, or at least halfway through the financial year, to enable you to get enough salary sacrifice in financial year. If you sell the asset in June, and then, which some people have done, they've sold the asset in June and then called me and said, how can I actually save some tax? It's very difficult to do something with your scenario if you're an employed person. You're limited. Salary sacrifice has to happen into the future, and you're limited just with the amount of salary you've got left to pay in that financial year. So start it early on in the financial year. So we've got Joe here, $80,000 of wages and interest, a discounted capital gain of $25,000. We salary sacrifice $18,700, and again it's the formula of $70,000 times 9% less $25,000 gives us that figure. His taxable income is $86,300, pays income tax of $21,173, contributions tax of $2,805, that's 15% of the $18,700. So his total tax bill is $23,978, saving $4,394. So that's how you can save tax on capital gains. Another way to do it is to just sell the asset in a low income year. So if you retire or have a year off work or have a low income year, sell the asset in that year as well, and that can save tax as well. Mary's scenario is different. She's not employed, she just gets investment income. Now she can make what we call concessional deductible contributions. Now it's like salary sacrifice, but she doesn't need to have earned the income and then salary sacrifice. She can just make a contribution to super and claim a deduction on it. So if she didn't claim a deduction, her $37,000 taxable income with the $25,000 discounted gain would be $62,000. She'd pay about $12,000 tax. Now, what she can do is she can take her $25,000 discounted gain and put $25,000 into a super fund. It reduces her taxable income back to the $37,000. She'll pay tax at $3,182. She'll pay 15% of the $25,000 in contributions tax, but still she's going to pay just under $7,000 rather than $12,000, saving over $5,000 in tax. So what that actually looks like, rather than $9,625 in tax, Joe's going to pay $5,231. Mary, rather than paying $8,875 in tax, she'll pay $3,750. Rather than totally paying $18,500, they're able to reduce it to just under $9,000 in tax that they'll pay. So the total tax saved on the gain here is $9,500. So they're the two approaches to saving tax in terms of when you're liquidating an asset. A couple of things to be careful of is that you must make the contribution to a complying fund. You can only claim a deduction for the income year in which you make the contribution. So you've got to make the contribution to super in the year that your capital gain is triggered. And generally with property, I think it's the contract date, not the settlement date, that's triggered. You must have made a contribution on or before the 28th day of the end of the month in which you turn 75. So this is a good one for Jim, who's in his 70s. You need to make sure that you do it before you're 75. A valid notice with the trustee that you want to claim a deduction for that contribution. You must be entitled to make a contribution to super, so you must be eligible to make that contribution.